Out of all the things, gentlemen, that we talk about or that you think about every day, is China one of the big ones, or are there other things, David?
China, I mean, the Fed had sort of dominated the thought process at the end of 2018, and China was right there behind it. Throughout the year, I think the trade war was probably the biggest thing, adding to volatility, but then the big drop in 2018 was, I think, more Fed-induced. But right now, it lingers. But you just said the word in that last interview about the asymmetric nature where we are. Unfortunately, I kind of do think that right now, if a deal doesn't happen, it's really bad. And if a deal does happen, which it will, it's just sort of good. It's mostly priced in. And none of us can quantify it. But I clearly think the market is expecting that a deal's going to come. And I think the market's right to expect it. Both sides desperately need one. President Trump needs one more politically. China needs one more economically. But at the end of the day, I think it's going to happen.
Yeah. How about, Anders, you've always had an international outlook. I'm not sure that your sort of more friendly feelings toward the rest of the world make sense here or before.
I would say that the market this couple of weeks remind us how hard it is to predict in the short term, right? If you think about it, if I told you that earnings guidance for this year for S&P were at 8%, are now at 5%, just over the last 2 months, you've seen significant cut on guidance, that this quarter guidance year over year is now negative, you probably wouldn't guess the market's up double digits. Right. The way that I see it, you have a trifecta situation, which is Goldilocks here in the U.S., like moderate growth, inflation's contained. Then you have a Fed that has gone, you mentioned the Fed. I think that's definitely an effect on the markets that has gone from hawkish to dovish. And there's another aspect of it that I think is not talked enough, which is if you look at financial conditions, they have eased significantly the last 8 weeks. Credit spreads have actually looked much better. The dollar has softened, and the market has rallied. All those things actually ease conditions in the back of a Fed turning dovish. Right? So those in the short term, I think, are part of the reason as to why the animal spirits have awoken in the market.
They've woke.
Woke.
They're woke. They're getting woke
That's
to the
word
woke.
of the day.
Woke.
You think that there's a valuation advantage in foreign markets versus the U.S. still? In
the short term, I don't think the market cares about valuation. But if you're looking 5 years out, I still think that internationally it looks more appealing. I know we go back and forth, and depending where the markets are 1 week to the other, you might think one side's crazy versus the other. So in the short term, I just don't think the market cares that much right now.
Well, if the EU is going to disintegrate, I don't think I want to be invested over there.
Well, I would specifically look at emerging markets as a better play. I do agree that Europe has been a value trap, for the better part of the 5 years.
And if they've got EU car tariffs coming on Germany, and Germany's basically in recession already, and they're talking about maybe they'd retaliate against Tesla.
The interesting thing about Europe is that this trade conflicts, the worst basically outcome is for them because they have no leverage, they have no say on this.
You mean even the U.S.-China issues?
Yeah, the U.S. basically is winning the most out of this. China's hurt next, and then Europe is the worst because they have no negotiations in this. They have
China's Germany's biggest customer,
yes,
basically.
Exactly. So I think Europe's actually suffering the worst.
So what do they do if you're an EU? What do you do?
I think they have to change their business model, and that's going to take decades. It's not going to take years.
Did you adjust your S&P targets after December, or?
I didn't adjust S&P targets because we're not index investors. We're not looking to own the whole market. But I did adjust our expectation for our own equity returns just in the sense that valuations dropped. And so as we came into the new year, particularly in the spaces that we really like a lot, energy, financials, those valuations were really attractive. I do believe that right now you're seeing more normalized valuations. So you kind of have to moderate those expectations. But the issue about valuation with U.S. relative to the rest of the world, you could have said it every single year since the financial crisis. Every year. And yet, here we are, U.S. real GDP growth is 35% since the crisis. Europe's is negative. So the valuation sometimes is not producing an opportunity. It's telling you what's wrong. I think the emerging markets is the most attractive valuation, but not across the whole board. Not the big exporters, not the big commodity-sensitive space. I think you have to be selective even in emerging markets. But U.S. is where you want to park money right now.